The chart moved first. Then the volume appeared. No headlines yet, no explanation anywhere. But someone clearly knew. Retail investors did not. I remember watching the XRP chart that night. At first, it looked ordinary. Another slow session in a market that had been exhausted for months. The lawsuit between the SEC and Ripple had already drained most of the excitement out of the asset. Financial television barely mentioned XRP anymore. Most analysts had shifted their attention to Bitcoin ETFs and macroeconomic policy, and yet the chart looked wrong. XRP had not exploded higher. There was no dramatic breakout, but something subtle was happening beneath the surface. The candles were tightening. Small green movements appeared in the middle of otherwise quiet trading hours, the kind of movements that rarely attract attention. Then the volume started to build. Not retail volume. Retail volume arrives loudly. It arrives with social media noise and sudden price spikes. This was different. The order books began filling with large limit orders sitting patiently below the market price. Every time XRP dipped, liquidity appeared. Someone was buying. Carefully, quietly, repeatedly. At first the media ignored it. There were no breaking headlines, no urgent market alerts, but the blockchain never lies. When I started checking the largest XRP wallets, something unusual began to appear. Dormant wallets were waking up. Transfers were moving between addresses that rarely interacted with public exchanges, and all of it was happening while the SEC remained unusually quiet about the case that had defined XRP's entire narrative. That was the moment the situation stopped looking random, because when regulation pauses and institutional-sized liquidity appears, markets usually know something before the headlines do. But when I traced the wallets behind the accumulation, the real story started to reveal itself. The first signal was not dramatic. It rarely is. Financial markets rarely announce turning points with fireworks. Instead, they whisper. XRP had been drifting sideways for weeks. Price movements were narrow. Daily volatility had collapsed. For most traders, that kind of environment signals boredom, but experienced market observers know that quiet charts can hide powerful positioning. The first unusual sign appeared in the order books. Large buy walls began appearing just below the market price. They were not aggressive. They did not push the price upward. Instead, they waited. Whenever XRP dipped even slightly, those buy orders absorbed the selling pressure. Red candles would begin forming, then suddenly stop. The liquidity was thick. Someone was preventing deeper declines. At the same time, trading volume started increasing in small increments. Nothing dramatic, just a steady rise. This kind of volume pattern often appears when large players accumulate positions without moving the market too quickly. Institutions rarely chase price. They prefer patience, because pushing price upward too quickly attracts attention, and attention raises costs. So instead, accumulation tends to happen during periods of uncertainty, during moments when retail investors feel exhausted, and during times when the broader narrative around an asset appears negative. That described XRP perfectly. The SEC lawsuit had created years of doubt. Many retail investors had already exited their positions. Media coverage had moved on. But the blockchain data suggested something very different, because behind that quiet chart, large capital was beginning to move, and the wallets responsible were not new. Some of them had been inactive for months, some even longer. Then suddenly they were awake again. Blockchain transparency offers a rare window into market behavior. Every large transaction leaves a trace. Every accumulation pattern creates a footprint. But most investors never look. They watch price charts instead. The wallets that began moving during that quiet XRP period were unusual. They were not exchange wallets. They were not retail accounts. Their transaction patterns were precise. Funds moved in large blocks, often between addresses that had interacted before. Then those funds slowly began entering liquidity pools connected to trading venues, but not all at once. The flow was controlled, measured, deliberate. That kind of movement is often associated with institutional trading desks or large investment entities managing significant capital. Another interesting detail emerged. These wallets were not buying during the most visible hours of the market. Many of the transactions occurred during periods of low liquidity, late at night in U.S. trading hours, early morning in Asian markets. These are windows where large orders can be placed quietly, where the market absorbs accumulation without attracting too much attention. At the same time, something else was happening on exchanges. Large sell orders appeared above the market. At first glance, they looked bearish, but they had a different effect. They discouraged retail traders from entering. When traders see large resistance walls, many hesitate. That hesitation creates time that large buyers can use to accumulate beneath the surface. The result was a controlled environment. Retail traders believed the market was weak, but the blockchain was telling a different story. XRP was being collected, carefully, quietly, and whoever was doing it had patience. Retail investors rarely react to subtle signals, they react to emotion. And during that period, the emotional narrative around XRP was deteriorating. Financial media continued discussing regulatory uncertainty. Commentators debated whether the SEC case had permanently damaged Ripple's future. Some analysts predicted that institutional investors would avoid XRP entirely until legal clarity arrived. For retail holders, the message felt discouraging, and markets respond quickly to discouragement. Small holders began exiting their positions. The sell orders were not large individually, but collectively they created downward pressure. Each dip triggered more anxiety, more stop losses, more selling. On the chart, the candles looked negative, red candles stacking slowly across multiple sessions. For many viewers watching the market casually, the interpretation was obvious. XRP was losing momentum, but the deeper market structure told a different story, because each wave of retail selling was being absorbed almost instantly. Large buyers continued placing liquidity below the market. The price rarely collapsed. Instead, it stabilized quickly after every drop. That kind of behavior suggests strong demand waiting underneath, and strong demand usually comes from investors with longer time horizons, investors who are not reacting emotionally, investors who understand something about the market narrative that others may not yet see. Meanwhile, retail sentiment continued deteriorating. Social media discussions became pessimistic. Some long-term holders publicly announced they were giving up. From a psychological perspective, this is often the stage where accumulation accelerates, because when retail confidence disappears, liquidity becomes available, and large investors are always watching for that moment. While the market was focused on short-term price movements, regulatory developments continued unfolding quietly. The SEC lawsuit against Ripple had dominated XRP's narrative for years, but during this particular period, the public conversation around the case became unusually quiet. Major headlines slowed. Legal updates appeared less frequently in mainstream coverage. For many investors, the silence created uncertainty, but regulatory silence can sometimes signal progress rather than stagnation. Several minor court filings during that time hinted at procedural developments behind the scenes. None of them were dramatic individually, yet collectively they suggested that key phases of the case were moving toward resolution. Institutional investors pay close attention to those signals, because regulatory clarity changes the risk profile of an asset, and risk profile determines capital allocation. If legal uncertainty begins to decrease, the potential market opportunity expands rapidly, especially for assets like XRP that had previously been restricted by compliance concerns. Some analysts began noticing that the tone of legal discussions was shifting. The arguments were becoming more technical, less confrontational. Those changes rarely generate headlines, but they matter deeply to institutional risk committees evaluating whether exposure to a digital asset could become acceptable again. If large investors believed that regulatory clarity was approaching, early positioning would make strategic sense, because once public confirmation arrives, prices tend to move quickly, and the best entries are always the quiet ones, which may explain why accumulation patterns continued growing stronger while the public narrative remained uncertain. Institutional participation rarely announces itself, but it leaves patterns. The most obvious pattern appeared in the size of transactions entering exchange liquidity pools. These were not typical retail trades. Blocks of XRP worth millions of dollars were appearing consistently, yet they were rarely executed as aggressive market orders. Instead, they were broken into smaller pieces, executed gradually across multiple sessions. This technique is common in professional trading environments. It reduces market impact. It allows large buyers to build positions without dramatically moving price. Another interesting sign appeared in derivatives markets. Open interest in XRP-related futures began rising slowly, not dramatically, but steadily. When open interest increases alongside stable price action, it often suggests new capital entering the market rather than existing traders simply closing positions. Institutional traders frequently use derivatives to hedge or structure exposure. So rising open interest during quiet accumulation periods can signal sophisticated positioning strategies. At the same time, exchange liquidity data showed deeper order books forming around XRP trading pairs. Liquidity providers were expanding spreads. That behavior sometimes occurs when market makers anticipate increased trading activity in the future. It is a subtle signal, but an important one, because market makers rarely adjust liquidity structures unless they expect volume to grow. Put all these signals together, and the picture becomes clearer. XRP was not experiencing a random market phase. It was entering a structured accumulation environment, and the capital responsible appeared disciplined, patient, and extremely well-informed. Volume analysis often reveals what price alone cannot, and during this period, XRP's volume profile was shifting in a very specific way. Daily trading activity began clustering around certain price zones. These zones acted like magnets. Whenever the price drifted away, trading volume pulled it back. This pattern often forms during accumulation phases. Large investors concentrate purchases within narrow ranges. They want to acquire as much supply as possible without triggering upward momentum too early. Over time, these zones become areas of strong support because so much buying activity occurred there. Another signal appeared in the relationship between spot trading and derivatives volume. Spot volume began increasing first. Derivatives activity followed later. This sequence matters. Retail speculation often begins in derivatives markets, but institutional accumulation usually starts in spot markets where actual assets are being acquired. The fact that spot volume was leading suggested that real capital was entering the market rather than speculative leverage. Blockchain data supported the same conclusion. Several wallets continued accumulating XRP steadily over multiple weeks. The consistency of these purchases suggested a long-term strategy rather than short-term trading. What made the situation even more interesting was timing. All of this activity was occurring while public attention remained focused elsewhere in the crypto market. Bitcoin dominated headlines. Ethereum development updates attracted analysts. Meanwhile, XRP quietly built structural support beneath its price, and markets have a long history of surprising investors when quiet accumulation phases finally end.